Hello, all. Good evening and welcome. I'm Mamta Rawat from the Corporate Communications team of CareEdge. I welcome you to our discussion today on Beyond the US Plate Unlocking New Horizons for Indian Shrimp Exports. We sincerely appreciate you taking the time to join us for this webinar. We would like to welcome our esteemed guest speakers for today. Mr. Pawan Kumar Gunturu, Managing Director at Sprint Exports Private Limited. Mr. Phillips Thomas, Managing Director at Penver Products Limited. Mr. Ganga Irrinki, CEO at Suryamitra Exim Private Limited. This session will be moderated by Karthik Raj, Director at CareEdge Ratings. We will commence the session with a presentation by Ratheesh Kumar, Associate Director, and Tejeshwar Reddy, Associate Director at CareEdge Ratings. This will be followed by a panel discussion and a Q&A session. In case of queries, participants are requested to key in their panel. We will take up your queries at the end of the discussion. Now, may I invite Ratheesh to make the presentation.
Thank you, Mamta. Good evening to one and all. I'll be taking you through a presentation on the Indian shrimp industry. So let me quickly walk you through the flow of today's session. We will begin with an overview of the Indian seafood industry, looking at the ecosystem, recent trends, and overall positioning. Next, we will narrow the lens to shrimp, which is the most critical segment for today. We will cover the global dynamics, key players, and India's standing in world trade. We will then look at the US market in detail, covering tariff challenges and India's product mix advantage. From there, we will move to opportunities beyond US with a focus on China, Japan, and UK. We will wrap up with the key findings, competitive insights, and a review of financial metrics and rating coverage of leading industry players in India. To set the context, we will begin with a broad overview of Indian seafood ecosystem. India is the fifth largest seafood exporter, with export totaling around $6.7 billion in calendar year 24. We have a vast coastline of nearly 11,000 kilometers and close to 1 lakh inland farms spread across 1.6 lakh hectares. The supply chain is well supported by around 50 feed mills, over 450 hatcheries, and more than 650 processing units with a total capacity of around 38,000 metric ton per day. Now, if you look at the product mix, shrimp dominates over 70% of the export value, whereas other seafoods like squid, cuttlefish, and octopus add some diversification to our export basket. On the demand side, the US is our single largest market, followed by China, Japan, and Southeast Asia. The key message here is that India has an industrial base, natural resource to scale up, but our high dependence on shrimp, higher concentration with the US market creates both opportunities and uncertainties. This we will explore further in the upcoming sessions. Now, let's look at the composition of Indian seafood exports. Export volume have grown from around 10.5 lakhs metric ton in calendar year 20 to 14.5 lakhs metric ton in calendar year 24. In value terms, export reached their peak in calendar year 22 at around $7.5 billion before coming down due to price corrections, which then remained largely stable over the last 2 years. Now, if we break this down, non-shrimp products such as squid, cuttlefish, and octopus make up almost half of the total export volume in 2024. But in value terms, they contribute only about a quarter. Shrimp continues to dominate the basket, accounting for nearly 3/4 of the total export earnings. If you look at the chart in the right, showing details of non-shrimp exports, we can see that this is a kind of a stagnant market for the past 3 years, and even recorded a 12% decline in the calendar year 24. That said, the non-shrimp export market is relatively well diversified, with China, Thailand, Europe, and West Asia being the primary destinations. Here, US share is negligible, which means the recent tariff action by US are unlikely to materially impact the non-shrimp export from India. Now, let's shift our attention to the shrimp sector. In this section, we will look at the broader global dynamics, India standing in the international market. We will also review the key competition shaping this industry. So if you look closer at the global shrimp market, on the chart to the left, you can see how global shrimp export have trended over the past 5 years. The chart also shows the contribution from major exporting countries during this period. Much like we observed in the previous slide for non-shrimp segment, global shrimp export also peaked in calendar year 22 and then moderated and remained stable for the past 2 years. On the supply side, India and Ecuador together accounted for almost half of the global trade in calendar year 24. Ecuador has steadily gained ground, raising its share from around 16% in 20 to 27% in 24. This growth was supported by robust farm output in this country. Same time, India could maintain its stable position with around 20% share over this period. On the demand side, US continues to be the single largest consumer, though its share has eased from around 31% in calendar year 22, 27% in 24. If you look at China, we can see that it has steadily expanded its presence, moving from 14% to 19% over the same period. This signals China's growing influence in shaping this global shrimp trade. So overall, what we are seeing is a market increasingly defined by a supply duopoly led by India and Ecuador, and at demand concentration between US and China. Now, let's look at how shrimp volumes and realization have trended over the past 5 years. In terms of the volume, global shrimp export have shown resilience, growing from about 29 lakhs metric ton in calendar year 22, nearly 36 lakhs metric ton in 24. But the picture changes when we look at realizations. Prices peaked at around $8.2 per kg in 22 and then fell to $7.1 per kg in 24. This was due to the persistent pricing pressure in the sector in the recent past. One thing maybe notice that India and Ecuador continue to dominate the global market, but with a very different approaches. India has a stronger presence in the processed and value-added products, and its realization is typically between $6.8 to $7.8 per kg. Ecuador, on the other hand, has lower realizations, around $5.7 to $6.9 per kg. This is because Ecuador focused majorly on this raw shrimp export area. So here the key point is that global volumes have remained steady, but profitability has been under pressure. This makes the value addition a critical differentiator for sustaining the margins and competitiveness in the global shrimp market. Now, let's focus on the Indian shrimp export. In terms of the volume, India's shrimp export have remained broadly steady at around 7 lakhs metric tons annually, while in value terms, it was ranged between $4.2 to $5.7 billion over the past 5 years. US is by far the largest destination for Indian shrimps, accounting for nearly half of the export value and more than 40% of the volume. In calendar year 24 alone, India shipped shrimp worth around $2.38 billion to US. So this heavy concentration means the recent tariff action by the US represent a clear value at risk for Indian exporters. China, if you see, China is the second largest market, absorbing close to 20% of the export volume and contribute only 15% of the value. China imports primarily this raw frozen shrimp with limited demand for value-added products, and realization in export to China are relatively low. Beyond these, UK, Vietnam, and Japan contributes a smaller yet relatively stable share. In addition to this, European Union and rest of the world together accounted for around 25% of the India's export. This part of the market is highly fragmented, but it continues to provide a steady base of demand. Key message here is that currently India has significant reliance on US market, and it is very critical to diversify our export footprint to mitigate this risk of a higher tariff or policy uncertainty. Now, let's have a closer look at the US shrimp market. United States is by far the world's most critical shrimp market, sourcing more than 90% of its need through imports only. For the past 5 years, India has led this leadership position there. It consistently supplied close to 40% of the US shrimp import. That said, competition has intensified in US market. Ecuador has emerged as a strong challenger for India. Ecuador market share has climbed from around 22% in calendar year 20 to 27% in the past 5 years. This growth was aided by their cost competitiveness. If we closely watch, we can see that overall value of US import also has declined from around $8.3 billion in calendar year 22 to $6.3 billion in 24. Same time, Ecuador has improved their share in the same market, US market. But despite this falling demand and a rising competition from Ecuador, India could maintain its share broadly steady. This highlights India's entrenched position in the US market. Now, if we look at the recent trend, in first half of calendar year 2025, US has imported around 4.12 lakhs metric ton shrimp, which is around 18% higher than the import done during the same period last year. We can see that India continued to maintain its share stable even in the recent months amid the tariff uncertainty. Let's now look at the mounting tariff pressure. and how they are reshaping India's competitive position in the US shrimp market. On April 2nd, 2025, the US government announced reciprocal tariff on multiple countries. This measure was initially paused for 90 days, during which a flat 10% tariff was imposed across all countries, and this extended till August 7th. However, on July 31st, US took a more aggressive stance. A 25% reciprocal tariff was announced for few countries, including India, whereas other shrimp exporting countries got lower tariff compared to India. This was quickly followed by another hike of additional 25% on India. It is important to note that these tariffs are not standalone. They come on top of the existing anti-dumping duty of 2.49% and a countervailing duty of 5.77%. As a result, India's effective tariff burden on shrimp export has surged to nearly 58.3% from late August 2025. From a competitive perspective, India was already at a disadvantage relative to Ecuador because Ecuador faces lower anti-dumping and countervailing duty compared to India. In contrast, India had maintained some edge over Vietnam until earlier last year. But with this recent tariff escalation, that balance has shifted. India's duty differentials versus Ecuador has widened, while its earlier advantage over Vietnam has reversed. This leaves Indian exporters in a distinctly weaker position in their largest overseas market. The broader takeaway here is that there is a tariff headwind which highlights the urgent need for India's seafood exporters to diversify beyond the US market. Now, let's look at some strategic advantage for India. In the previous slide, we were discussing about the tariff disadvantage in the US market for India. Here we turn to the structural advantages that help to offset some of that pressure. If you look at the product mix in US shrimp import in calendar year 24, we can see that US majorly imported processed or value-added shrimp. Peeled or processed category of shrimp makes about 50% of total import volume of US, while value-added products contribute another 23%. That means together these two categories account for nearly 3/4 of US demand. Whereas raw shrimp import or shell-on category is only about 25% of the overall US import volume. Now let's see how who all are contributing to each of these segments. From a chart towards the left, we can see that India supplies 59% of the US peeled shrimp demand, far ahead of Ecuador at 21%. Now, in value-added product as well, India maintains around 28% share versus Ecuador has negligible 4%. By contrast, Ecuador dominates the shell-on segment with around 48% share, while India accounts for only 11%. As US consumers prefer more of processed and value-added shrimp than these raw or shell-on categories, India holds a clear strategic advantage over Ecuador. Additionally, India's farming model is aligned with the US appetite for 30 and lower count grades, whereas Ecuador focuses on a higher count varieties. India has established processing facilities, vast labor force, robust supply chain. These things will strengthen our position in this processed and value-added segment compared to any other competitor. This strategic position provides India with a durable competitive edge in this US market, offsetting this tariff headwinds to some extent. Having said that, what is the way forward? To ensure long-term sustainability of India's shrimp export, it is critical for exporters to diversify and expand their presence in alternate markets beyond US. On that note, I would now like to invite Mr. Tejeshwar, who will take us through the opportunities emerging in these markets.
Thank you, Ratheesh. Now let us look at few alternative markets for Indian shrimp exporters. Let's look at China as potential growth market for Indian shrimp exports. China's shrimp imports expanded significantly between CY20 and CY23, both in terms of value and volume. Import values increased from CY20 onwards and peaked at USD 5.6 billion in CY22, supported by demand recovery following the lifting of COVID-19 restrictions. However, demand moderation in subsequent years led to a decline in import levels. Ecuador has consistently dominated this market, accounting for 65 to 70% of China's shrimp imports in recent years. By comparison, India's share has remained in the range of 15 to 20%. While smaller, India holds two notable advantages over Ecuador in serving China. One being tariffs. Indian shrimp attracts an import duty of 2.5% compared to 4% to Ecuador. Second is logistics. Shorter sailing distances allowing faster deliveries and potentially lower freight costs. These factors could provide a cushion for Indian exporters, particularly if Ecuador diverts more volumes towards the US, where price realizations have turned unfavorable. That said, structural challenges remain. Chinese demand is skewed towards shell-on shrimp, a segment where Ecuador enjoys a natural competitive edge. India, with its strong presence in processed categories, may find its ability to capture incremental growth constrained unless it adapts its product mix to match market preferences. In summary, while China offers a meaningful diversification opportunity for India, the scale of gains will ultimately depend on exporters' ability to align product offerings with evolving Chinese demand dynamics. Now, let us take a look at Japan. Japan represents a mature and relatively stagnant shrimp market. Import volumes have remained steady at around 2 lakh metric ton annually since CY20, with imports in terms of value broadly stable in the range of USD 1.8 to 2.2 billion. This maturity limits the scope for meaningful growth. Vietnam continues to dominate the market with a 25 to 30% share, while India consistently ranks second at 15 to 20%. However, India faces strong competition from Indonesia and Thailand, particularly in value-added product categories where branding and differentiation are critical. Ecuador's presence in Japan is limited, which reduces direct competitive pressure, but also means India cannot expect to benefit significantly from any diversion of Ecuadorian volumes. The key takeaway is that Japan provides diversification beyond the US market, but its stagnant demand profile and competitive dynamics imply that India's focus here will be on maintaining existing market share rather than following substantial incremental growth. Taking a look at UK market, coming to the UK shrimp market, it is relatively modest in scale, with annual imports valued at around USD 0.7 to 0.8 billion and volumes steady at about 0.8 lakh metric tons in recent years. In the first half of CY25, imports moderated further to USD 0.38 billion, with volumes at 0.36 lakh metric ton. Vietnam again is a dominant supplier, consistently accounting for 25 to 30% of UK imports, while India holds a smaller but rising share of around 15%. Ecuador and Honduras are present but remain secondary players. A key development is the India-UK Free Trade Agreement, which eliminates import duties on Indian shrimp, placing India on a level playing field with Vietnam and giving it a clear tariff advantage over Ecuador. Combined with shorter supply chains, this could enable India to expand its market share meaningfully. While the UK market is structurally small compared to the US or China, the FTA presents an opportunity for India to strengthen diversification. If leveraged effectively, this tax advantage could help India double its share in the UK by 2026. Coming to the outlook for Indian shrimp exports, in CY24, India exported just over 7.3 lakh metric ton of shrimp globally. CareRatings expects a marginal decline of 1 to 2% in CY25, with market level trends in terms of geographies as follows. The United States saw strong front-loaded growth in early 2025, but annual volumes are projected to fall from 3 lakh metric ton in CY24 to 2.8 lakh metric ton in CY25. A sharp drop is likely in CY25 in case the tariff sustains at an existing level. While China is expected to remain supportive, with volumes rising from 1.4 lakh metric ton in CY24 to 1.84 lakh metric ton in CY26. UK, though small in scale, volumes are set to grow gradually from 0.12 to 0.2 lakh metric tons by CY26. Japan and others are expected to collectively expand from 2.77 lakh metric ton in CY24 to around 3 lakh metric ton in CY26. Overall, export volumes are projected to decline by about 10 to 12% in CY26 versus the previous year. On value, India's shrimp exports are expected to fall by around 16% to USD 4.18 billion in CY26 as tariff-driven pressures weigh on demand. Realizations per kilo should hold steady in CY25, supported by value-added exports, but could see a decline by about 5 to 6% in CY26. The key takeaway is India's entrenched US presence and strong processing base provide some resilience, but sustained tariff pressures will weigh on performance. Diversification into China, the UK, and other markets will help soften the impact, though it is unlikely to fully offset the losses from the US. Now, before concluding with key findings on industry dynamics, let us look at movement of shrimp feed costs relative to key raw material prices. Shrimp feed costs remained broadly stable at around 65 rupees per kg during FY 17 to 20, while raw material prices were more volatile. However, from FY 21 onwards, both moved upward, but feed cost increased more sharply during FY 22 to 24, widening the spread. In FY 25, raw material costs corrected significantly. However, feed prices eased only marginally, leaving farmer input costs elevated. At the same time, farm gate shrimp prices in 2025 have remained consistently lower, down 20 to 30 rupees per kg year on year during January to March, with only a brief recovery in April, further squeezing farmers' margins. For Indian shrimp exporters, this creates a mixed scenario. While lower shrimp prices enhance cost competitiveness in international markets, persistently high feed costs and weak farmer realizations may dampen stocking decisions, potentially constraining long-term supply stability and export volumes. Now let's summarize our findings. Starting with India's advantages, India enjoys several structural advantages in the global shrimp industry. Higher farm productivity and a strong base in processing and value-added shrimp provide a solid foundation. India's long-standing presence in the processed shrimp segment positions it well to capture opportunities aligned with evolving global trends. Lower processing costs, abundant labor availability, and reliable power supply further enhances competitiveness. However, on the other hand, India faces some disadvantages relative to competing exporters. Shrimp farming is burdened by higher feed costs, while longer sea lead times to major consumption centers add to logistics challenges. The recent escalation of tariffs had eroded India's competitiveness to some extent, particularly against Ecuador, which not only benefits from lower access barriers in key markets, but also enjoys a dominant position in China, one of the fastest growing consumption hubs. Coming to the key findings, India's shrimp export volumes are projected to contract by 10 to 12% in CY26. The US market remains the biggest risk factor, though diversification into China, the UK, and other regions could provide partial cushioning over the medium term. Operating profitability is expected to decline by about 100 to 150 basis points, driven by sustained tariff pressures and weaker volumes. Now, monitorables would be to watch include the outcome of ongoing bilateral trade agreement discussions between India and US. In parallel, the pace of diversification into alternative markets, currency movements against major buyers, and the extent of tariff burden sharing across the value chain will remain critical. Additionally, government initiatives and continued support from lenders to the aquaculture sector are expected to remain critical factors under surveillance. In summary, while India retains structural advantages, its ability to sustain competitiveness will hinge on policy outcomes, effective diversification, and continued focus on cost efficiencies. Now, let us take a look at financial aggregates of entities rated by CARE. The sector's operating income grew steadily from about 12,500 crore in FY21 to 17,300 crore in FY24. There has been a marginal moderation in FY24, reflecting a slight softening in demand. TOI is estimated to be around 18,500 crore in FY25, which represent about 45% of the income attributable to care-rated entities. Operating margins remain broadly stable in the range of 6.8 to 7.2% up to FY24. They are estimated to decline to around 6% in FY25 due to imposition of additional duties, that is countervailing duty, which all the exporters were not unable to fully pass on to the customers. Margins are expected to recover by about 70 basis points in FY26, supported by front-loaded shipments and pass-through of CVD and reciprocal tariffs. However, if the 50% tariff sustains, operating margins could moderate by up to 150 basis points in FY27. On the capital structure, the sector's capital structure has remained stable over 5 years ending FY25, despite total debt rising from about 3,500 crore at the end of FY21 to 5,000 crore at the end of FY24. Gearing has stayed close to unity at 1.05 times as at March 2024. While working capital borrowings increased in FY25 and leverage is expected to deteriorate marginally, a recovery to below unity levels is anticipated by FY27. Interest coverage, though easing to an estimated 2.37 times in FY25 from a peak of around 6 times in FY22, led by incremental working capital borrowings over a period of time. However, it continues to reflect adequate debt servicing capacity. Coming to the rating dispersion of care-rated entities, Out of the rated portfolio, only 11% entities are rated in A category, highlighting that relatively few companies exhibit strong credit fundamentals. However, they account for higher share of debt, that is around 32%. The rated portfolio is skewed towards BBB category, which accounts for 63% of entities, reflecting moderate credit quality with adequate capacity to meet financial obligations, but susceptible to adverse business or economic conditions. They also carry the largest share of debt, that is about 66% of the rated debt. Around 26% of the entities fall under BB and below, indicating a weaker credit profile and higher vulnerability to stress. However, these entities carry only 8% of overall debt, suggesting weaker players are typically smaller in size. However, they also carry a lower borrowings. Now, in terms of number of upgrades and downgrades, the data highlights a clear shift post FY21 when downgrades outweighed upgrades during the pandemic affected period. However, from FY23 onwards, the trend reversed, with upgrades outpacing downgrades, reflecting improved operational performance, demand recovery, and strong financial management across entities. That brings us to close of our presentation. I'll now pass it on to Mamta to take it forward.
Thank you, Ratheesh and Tejeshwar. Attendees are requested to key in their questions, which we will take up after our panel discussion. Now, may I invite Karthik to take over the session, please? Karthik is a credit risk professional with over 17 years of experience in corporate credit appraisal and ratings, complemented by a background in equity research and fund management, an engineering graduate with a postgraduate degree in management from the Premier Business School, demonstrating strong leadership and a proven individuality. Currently leading the credit rating function for the mid corporate segment across Karnataka, Andhra Pradesh, and Telangana. Over to you, Karthik.
Thank you, Mamta. And thank you, Tejeshwar and Ratheesh, for a data-rich presentation. Foremost, my sincere thanks to our esteemed panelists who could take their time to be here and to share their insights. Today, we have our first guest, Mr. Pawan Kumar Gunturu. He is the Managing Director of Sprint Exports Private Limited. He is a civil engineer and an MBA from Hals University, London. He joined the seafood business in 1997, having 27 years of experience in production and sales. Mr. Pawan Kumar is currently the National President of the Seafood Exports Association of India, where he is currently playing a key role in representing and advancing the interest of the Indian seafood exporters. Sir, warm welcome.
Thank you, Mr. Karthik.
Next, we have Mr. Philip Thomas, who is the founder and managing director of Penver Products Limited. And with over 3 decades of experience in the seafood industry, he has played a pivotal role in shaping the Penver to a fully integrated enterprise with a global footprint. I think today Penver is a diversified group with operations spanning across feed distribution, aquaculture farming and processing, exports, and a dedicated import distribution arm in the United States. And coming from the family which pioneered seafood exports from India, Mr. Thomas combines industry expertise and entrepreneurial drive. His leadership has positioned Penver as a trusted partner for the leading global retailers and food services company. Sir, good to have you.
Thank you so much.
Our next guest, Mr. Ganga, is the CEO of Suryamitra Exim Private Limited, belonging to Suryamitra Group of Companies. He holds a bachelor's degree in electronics and communication engineering and MBA from Dominican University, Chicago. Since 2008, he has been instrumental in scaling Suryamitra into one of the leading exporters of processed shrimp from India. His expertise spans across aquaculture farming, hatchery management, international sales and marketing, business operations, banking, and mergers and acquisition. Mr. Ganga is also a national committee member of the Seafood Exporters Association of India, actively engaged with the Ministries of Commerce, Finance, and Banking, contributing to the key policy amendments and representing the industry's interests at both national and state level. Sir, warm welcome to you, sir.
Thank you.
Let me start with on the India's competitiveness over the other countries with Mr. Pawan Kumar. So India has a strong, as we saw from the presentation, has a strong processing capabilities and enjoys a very strong market position in the peeled and value-added shrimp, which actually aligns well with the US consumer demand. And can these structural strength meaningfully offset the very significant 58% tariff disadvantage that we are talking about? Are we looking at this pricing inevitably weakening India's competitiveness other the competing nations?
See, Mr. Karthik, thank you so much for having us here. Uh, First, let us accept, yes, the tariffs are here, but they're not here to stay. Uh, Pretty soon they're going to go away, or there's going to be some sort of relief from the tariff for the Indian exporters, especially the affected sectors, which includes the seafood sector. Um See, if you look at the Indian seafood basket or exports over the last 20 years, and if you look at the investments what the exporters have made in the last 10 years, especially last decade, which has been phenomenal. The reason why I said phenomenal is the kind of investment which has gone into infrastructure development and the kind of infrastructure development our exporters have done with state-of-art facilities which are being developed across the country. Probably they are one of the best infrastructures developed in the world, I can say. The reason why we have done is to have a competitive edge in the value-added segment, which we visibly did it in the US market by capitalizing the US market. When we started exposed to US, our predominant products were only the headless shell on blocks. And when I started in the late 90s, it was predominantly headless shell on blocks is what we were doing to US market. But we quickly transformed into the value-added products like the PDs, PD tail-ons, easy peel, cooked, and other even today breaded shrimp. All that we have uh, capitalized that market or nourished that market over the last 15, 20 years. Uh, yes, these tariffs have is a temporary setback, I would say, which we do not want to lose that edge in the market, and we do not want to lose the market. Hopefully, both the governments will sit together and sort this out very soon, and we should be back to normal as far as our exports to the US are concerned. Uh, not only US. Europe is one good market for Indian shrimp, especially in the value-added segment, and we are trying to expand our footprints into Europe. You must have seen the kind of good news what we got in the last 2 days about the factors being approved and all that, and we are going to increase our footprints in the European market also.
Okay. Yeah, thanks for your input, sir. I think you're bringing in that perspective that the kind of infrastructure which is the state of the art in the world, which has helped us grow from what we used to be predominantly a shell-on market to a value-added segment. And this is something that this is a very strong strength for India, and which will be very critical to retain the US market. Thanks, sir.
Yes.
Let me bring in Mr. Philip Thomas. Sir, in continuation of the previous question, do you see a risk of Ecuador moving into processed and value-added categories now that India is at this particular tariff, and if this tariff sustains, then there is an opportunity for Ecuador. But at the same time, do you expect this? What is the kind of investment and capex which is required for Ecuador to make in the shrimp processing sector to tap the US opportunity?
See, what is going to happen is they simply, in a faster pace, cannot come into the value-added product. It requires a lot of investment that is required. Number two, it requires time to transform. And they also have a labor disadvantage compared to the Asian peers. So, see, their currency is in US dollar. So their cost, as far as the labor is concerned, is very high. And their labor is not equipped to process the the value-added product. I cannot say that they will not come in with this huge, tariff difference. I'm not saying it is not possible, but it will take time. But I am hopeful that our government will work towards bringing the tariff down. If we come to probably to 25%, of course, we have a slight disadvantage with them. I'm sure they will not eat into much of the Indian sector. It is going to take time as far as they're concerned. But of course, they pose a risk for sure.
Okay. Thank you, sir. Mr. Gangaram, would you like to add to Mr. Thomas's view? I mean, particularly, again, beyond Ecuador, if you may also comment on other countries like Indonesia and Vietnam too. How are they placed? What would drive the private investment in these countries? Will tariff be a motivation for long-term investment in these places? Or will uncertainty actually hold them back And if so, I think he was also, Thomas was mentioning about it will take time and it's a lot of investment is required. So how long will they hold back?
If, for example, you go to history of India, right? We started One of My Culture in 2010. It took about 15 years for us to grow the business so long, because not just on the infrastructure, we need people, the quality compliance is required, approvals from the retailers are required. And now I think Indonesia, if you see out of 16 lakh tons, they're only doing 2.5 lakh tons as a value addition. So it's when you compare to the quantum of value addition what required, and out of total imports on ready to eat like cooked products, India is number one today, irrespective of what is happening. And first thing everyone need to know, people always today comparing Ecuador and Indonesia, and you're showing a wonderful table of the tariff rate comparison of pre-April and mid and now what is today. You may see 58% what we are having today, but you need to understand while you're talking to our customers, they have limited capacity of peeling. They cannot buy that much product from there. And if you see, although they have only 18-20% tariff with them, they increase the price to 43%. So difference between India is only 8 to 10% today. They are not just trying to sell the product at 15% tariff. They're adding the margin of 20%. They're trying to sell at 43%. So today they're making a money of nearly about 18-20% on the margin today. And if you see the pricing of India and Ecuador on the price difference, it's only around 10 to 12% difference as on today. So, and if you see the raw material correction, which has happened from April till today in industry, there's 10 to 15% correction on the raw material price on the big size. Basically, so this all US is all about big sizes from 16, 20, 21, 26 up to 50 counts. So we never has reduced any price to the farmer on the small size, which are the basic requirements, because for farmer to do a culture, right, there is a minimum margin you need to have to sustain the business. So since it's a food-based industry, right, people are able to pay the price. And what are the price POs what we have? Buyers in the retail, only few of them has revised the price to 50%. And new people who want the product, they are giving with 50% rate to us. Nevertheless, obviously the volume can't be so high what we have earlier, but there is a correction phase and we are getting PO. It's not that completely it's dead market as of now. And people today have a lot of requirement, as I said, right? Ecuador is increase the price by 25%. Then although they have 15, around 43%, for example, 100 rupees a product sale, they are quoting today as 142 rupees. We are quoting at 150 rupees or 155 rupees, technically. So we are at a difference of only 13 rupees. So people need to understand at what price now US is buying from Ecuador. That information, maybe a lot of, we have already, along with Ms. Pawan Kumar, we have met Commerce Ministry, we have met with the RBI Secretary, RBI Banking Secretary and all. We explain the same thing, that people talk about Ecuador, but the pricing is the main constraint there in deliveries. They cannot deliver the quantum of product what we are having today. And when we're talking about demand, people may delay on buying clothes or any other products. Diamond, jewelries, and textiles also part of this tariff which are affected in India. And if you see the major consumption of protein, like beef product from which has been exported from Mexico and Brazil, right, which is the highest, $6 billion is sale for beef from Brazil to US. That is under 50% today. So shrimp is one of the products. So I don't think they really have the effect because it's a food product for protein, right? They're obviously consuming it. And now the only thing is people are waiting for discussion with both the governments to bring it down to 25%. Once that is done, then I think this will be back to normal. But today, what affecting us most is the delay in the operating cycle, because the inventories are there. Since a lot of people told to hold the inventories until the tariff is concluded, because till 27th of last month, we thought some conclusion will come, but didn't come out. So maybe this week we expect some positive hope. And then if they want to see today, buyers are ready to buy from India. Only thing they want to know is at what tariff is going to stay. So they are like, okay, 50%, if it stays, it is fine. But today what they're thinking is already now entries coming in US are at 50% now. They are worried they paid the 50% to us, and they are worried now suddenly they bring my 25% down, right? Who is going to bear the cost? So that is a concern they have. So I think this is a shorter time. It may change. And I think it's a food product, so they need to consume. And it will continue to have a demand. I don't think it's a transition time. We need to wait. And I think that's what we represented the banks and other people also, to increase the working capital cycle and moratorium. That's what we asked for the repayment. That's the only thing we asked. And also that post-shipment limit increase, not the pre-shipment, because today invoice value, which is 1 crore, is about 1.8 crores. So today, the requirement of post-shipment limit is more than the pre-shipment limit for the businesses today. And we also represented the government to work on the not only the exports EPC credits and the post-shipment credits. Also, we requested them to work on the TREDS, KCC limit for farmers, or asset-backed loans for traders who are in the value chain, right? So we are requested to give whatever it is being given, give to the complete agri-lending sector, not just the exporter, so that the chain has been, covered with this delay in the interest costs and other things. So we also requested in a meeting where we told TREDS instead of 90 days, we asked them to give to 150 days just to cope up this 2-month cycle, right? That's what we requested. So these things are under the move, and the government is working towards them. Only thing is we need to understand what is going to set tariff. Then everything comes into picture. If tariff is set at 50%, government will come up with moratoriums or extension of loans, and all these things are going to come because huge employment is in the industry, not only our industry, textile industry. So they're not going to just leave this like that. So we are very hopeful on that.
Can I say something, Mr. Karthik?
Yes, sir. Please, sir. Yeah.
Sorry to interrupt. I have a flight to catch. If you have something for me, please do. I need to rush.
Oh, I'm sorry. Okay.
I'm sorry because there was a last minute meeting which was called for in Delhi tomorrow morning. So I had to take the evening flight. So I know your people have been really following up with me, and I gave a time also, but unfortunately this came up.
And not an issue, sir. I'll just probably take your views on one particular aspect. I'll come back to that insight which Mr. Gangaram gave. I'll post it slightly later on that. But on the acreage and counts which are produced by competing nations, I think there was some reference to this earlier also. How does our farm acreage, compare with the competing nations? And like we have 1.5 lakh hectares of shrimp farming, and I think we understand the Ecuador has a much bigger farming area, but the productivity is not as high as in the US. And in terms of even the counts produced or different grades of shrimps in these countries, how important will it play in determining if the other countries can substitute India supply?
See, when we started our culture of anime in 2010, India, the world was surprised when India was giving the bigger counts, that is the 20 counts, 25 counts, which was never heard of in anime. Because the other countries which were producing anime were Indonesia and Thailand. And Indonesia and Thailand were Vietnam and Thailand, I'm sorry. They were basically producing the small counts, that is 60, 70, 80, all the way to 100, 120 counts, the smaller the sizes. But the world was surprised and shocked to see bigger counts coming out of India because our stocking densities were low, and the mortality was low. The quality of seed was very good. The farm preparation, farm qualities, everything it was almost like a virgin soil. So I think Ecuador is also going through the same honeymoon. Sooner or later, they might also come down to our cycles. Today, their stocking densities are low. So they're enjoying that benefit which is coming out of the farms, because more or less there are also virgin farms there. In terms of farm capacities, yes, Ecuador has vast extents of land than India. For them to increase the capacity, yes, it is possible for them. But the advantage, in case there is a disease cycle which comes up, because of the vast acreage each farmer holds in Ecuador, it is going to quickly wipe out. But vis-a-vis, when you talk about India, the advantage what we have is the small farm holdings. That is the biggest advantage what India has. I don't. That is so. If there is any disease spread, it is not going to hit India that harder as hard as it hit Indonesia, Vietnam and Thailand. So volume wise, yes, I don't. You're rightly said. Ecuador can quickly ramp up, but I don't think they will do that because they need to find a market also for that. And see, the honeymoon, as far as the tariffs are concerned, is not going to stay long. This is going to end somewhere, and India is going to be more competitive than Ecuador in the near future. That I can vouch for it, because the government is not going to let go things like this.
Okay. Thank you, sir. Thank you, sir. I think,
If you allow me, I'll log out. I know there are two other capable person better than me in the panel, Mr. Philip and Gangaram. They'll be able to do better. Probably they'll be able to express better than me. Thank you so much.
Thank you for having you here, sir. Thank you.
Thank you. Pleasure.
Yeah. So I think a couple of points which came out, that Ecuador's investment in a fresh capacity is going to take a little longer, and even if I'm considering the volumes, while they may have the capacity to in terms of acreages, but if they have to supply both China and US, it could be a big ask. So should India double down on strengthening its value addition capabilities, or instead prioritize actually diversifying into other geographies? Mr. Thomas, if you can give us that view.
Sorry, I didn't hear that question. Can you?
Yeah, I was asking on whether India should double down on its strengthening its value-added capacity, its capabilities there, or instead try to diversify into other geographies, because Ecuador could take a little longer time to actually establish if we want to really move into the value-added segment.
Definitely, we should see what has happened is the mistake. What the Indian exporters have done is we have found the easy path, which is basically US market, which was the biggest market, and we could safely eat upon the other, Thai and the Vietnam, the sector, their pie. We moved into that and we started. I have to agree that, exporters, we never looked at other avenues. We were happy with what we had with the US. Definitely, we need to look at other markets. There is opportunities in other markets. We need to look at the possibilities of expanding. Again, there is a lot of value-added sector that is available as far as China is concerned, where they are processing in-house, which we could definitely, which we could definitely look at and take over. So there are avenues which we should look at and we should expand. Of course, we have a bigger advantage as far as everybody is concerned in terms of value-added products. I have to tell you, with the kind of volumes that come out of Ecuador, they cannot produce, it's close to about 1.4 million or 1.6 million pounds that comes out. They don't have the labor or capacity to get into value-added products. So we have the strength, and we can, US market, we can continue to, maintain if the tariff comes down, which definitely the tariff will come down, which we are hopeful. And we need to definitely look at other markets. We need to start concentrating on other markets.
Okay. Mr. Specifically on, let me go through some of the key geographies. Mr. Gangaram, if you can, the next question is to you, that China, this China remains largely a shell-on dominated market, but how does India recalibrate its product mix to serve this market, effectively without compromising its, our processing advantage?
So, regarding China, right? First, everyone should understand their major consumption is imports from head-on. There is a major consumption which they get from Ecuador. Second comes headless product, which is a major product what goes from India today. So today we have invested crores of rupees all exporters on value addition, and the valuation demand for China is not much. So today, whatever people are doing to China is like a stopgap arrangement, and people in China also, they have surplus product from other countries like Ecuador. And when we are not having market access, like a lot of exports in India may not have market access to US with the high tariffs and high bonds. So they have alternate markets. Immediate market for liquidation is Chinese market is the highest, fastest, which goes in 15-20 days the liquidation time. So that market they look into, but we see the price per unit, right? Technically speaking, the price per unit for China and the US, the cost is nearly 80 to 90 rupees difference on the revenue side. So it's not a small amount for the tonnage what we are doing. And we cannot just focus on maybe more than focusing on China on the products. Maybe we have Europe or any other countries like Canada, some other countries like you do Japanese value addition like Nobashi. So those things are like, we can have a higher price per unit, but immediately to move the volume, right? What we have, I think this is the only way is like, you focus on the existing buyers in US, right? Already they're giving the tariff. So as of now, there's no such like immediate risk which is happening. So I think we need to wait for time next 2 months and see how it's going to change. But I don't think the complete volume you're talking about can be, there's no meaning of scaling down the operation, right? So we don't need this much workforce. For example, each factory today, we have about 3,000, 4,000 workers because we have peeling. So once you start doing headless, your workers requirement come down to 1,000 people. So it's all a completely not viable solution for a business to focus on Chinese market. So that's my take on that. But nevertheless, as on today, that is a savior for us. So
Okay. So, Mr. Thomas, on coming back to Japan, which I think probably a slightly a better value-added, demand market, but we also understand it's more of a mature and stagnant place, and I think earlier in the presentation it was pointed out that the competition is very stiff from Vietnam, Indonesian, and Thailand players. So, do we really have an opportunity to expand our presence into this market, Japan?
Definitely it is there. So if you really look at it, Japanese value-added product, Indian exporters have not looked at it very, very much. So if you look at Nobashi, their stretch shrimp, their all the value-added product, we have not looked at, because it is a time consuming. See, we were always, functioning on PD tail-on, headless, easy peels, and PD because it was very easy to process. So Thailand and Indonesia and Vietnam are the people who have really looked at going into more value addition. I would say probably into Nobashis and other things. Definitely, Indian exporters have looked at it, and this has become a necessity for us right now. See, we were complexed, right? Oh, okay, nothing will happen. I have my production 85% is going without, okay, I have 3 buyers, I'll get the 4th buyer, I'll go this way. Now, this is rang a bell that we cannot concentrate on one market, and Indian exporters have to definitely look at all these avenues rather than by having a decision saying that, oh, everything will, function properly. Now we have to definitely look at, and as far as Japan is concerned, the biggest area where we can look at is more value added, which will definitely bring in more value to the exporters.
Okay. I think we are talking about different dynamics in different markets. Japan requires India to really get into higher value-added categories, and then so while China may offer you a little bit of volume, but it's not a viable solution, as Mr. Gangaram was pointing out. So, how do we actually? Again, I mean, these are very different markets. There are different opportunities, but challenges are also different. How do we really, I mean, how does Indian players balance the export strategy now to spread across and to enter into the regions to reduce that US dependence without diluting the margins and sustaining the business also? Well, there are different markets we are talking. Yeah.
Yeah. So let's talk about China. For us to get into Chinese market more on a quantity basis, basically we have to concentrate on the head-ons. See, the structure of our farming, the way in which we harvest has to change. This is not going to be an easy process because it's small farmers which are concerned. These are not bigger farmers, marginal farmers, small farmers. It has to change. But this doesn't mean that we should not look at all these opportunities. That's number one. Number two is other markets, as I told you, if you look at the advantage, what Vietnam has is over to the EU market, their duty structure is down. So once we have government, we have the trade, these kind of trade barriers, this thing, we can definitely look at all that duty market. And there are unknown markets. We need to develop Russia. I hear there are decent volumes that is going right now from India. We need to look at this thing. We need to start promoting, there is no promotion that happens as far as seafood is concerned into, Indian seafood is concerned into Europe. So India has to be looked at. Southeast Asian market needs to be looked at. We have to look at every other markets and have to put in an effort as far as export is concerned to divert or to face this particular challenge, which we are every day thinking, okay, it's going to happen tomorrow, it's going to happen tomorrow. We don't know whether that will happen. So, but definitely as a company, we are going to focus, definitely going to focus from the 85% in next, 85% of exports going to US. In next 3-4 years, we definitely wants to bring our volume out of US down from that level, concentrate more to Japan. If you look at our company, this thing, our volumes have started going up. We are planning to put in more funds and develop more value-added products. So we will definitely look at such markets, which is available in Southeast Asia. This is available in Europe and other things. So more value addition, we would be concentrating in the near futures to bring our dependency down on US.
So
Sure.
adding
Yeah.
Karthik to that, actually regarding that UK-EU market, Southeast Asia, right? What you're asking about opportunities and challenges we face.
And how do we different challenges, different opportunities? Yeah.
See, the main thing is here, first everyone should understand food product what produced in India by any exporter, right, are under the food safety guidelines. Irrespective of the country, people think that testing in EU is more or UK is more or Japan is more compared to US. It's not like that. People should understand all over the world, global food safety compliance is same. You should not have antibiotics or anything as per the policy, right? So you need to understand each market and compliance side is same. And today, all the companies in India are at par with any international food safety importing guidelines. So rejection is not a big criteria. And when you see from your rating company's perspective, your bank's perspective, if you see 2 rejections or 3 rejections in a country, you get information as if like country is in the problem. So you should understand we're around 65,000 crores of business. That is around 65. For example, at shrimp, you take about 30,000 crores. It's 30,000 containers. Each container is 15 tons. Okay. Each kg is around 60 to 70 shrimp. Okay. So if you're talking about 30,000 containers and having a rejection of 10 containers or 15 containers, it is less than 0.05, less than very, very minimal. When it comes in news, they say it's like FDA rejection is happening for India. I don't understand that logic. And when a company like banks or rating companies, right, they don't understand. We do continuous testing at farm level before harvest, before export. EIC, Export Inspection Council, is in picture. They do tests in their labs and then we ship it. So we do utmost compliance. That is why the risks are very minimal. And today, when you're talking about company risk on rejections or receivables, I think in any businesses, seafood business is safest on receivables. You check because we are most of them does to US country, and all China and other countries are Japan or LC based. Chinese against wire transfer CAD, and all are covered with ECGC. Everyone is having whole turnover policy, right? So we don't have any risk of receivables. When you assess something is happening, this happens only when people send on collection, like maybe after delivery, keeping it for 2 months, 3 months. That is where you have risk. So you need to understand that when you are framing a policy for industry, you need to assess company wise. And these are the securities we are taking as a company, not and most of the companies does it. And we have rejection insurance from my door till customer door for marine rejection, anything. So people have a rejection cover also. You say like a containers get distracted. So we don't have any issue. We get 110% of the invoice value, right? So any country regulations are there in place. Only thing as far as companies are concerned, we need to take care on the receivable risk, which is most important for banks or any rating companies. And I think most of them are at par with it. And regarding compliance, you see that you have a UK trade agreement, FTS happened. And we were last 2 months, we are following up with Commerce Ministry and reducing the number of testings for you, which is going to come in next 3-4 months, FTA. And we also talked about South Korean market. So delegation is going on within India and other countries. Our association is very strongly. Last 1 month, people see only what is happening at the international level. But back end, our seafood exporters association of India is working for everyone in the value chain. They don't know. But last 1 month, I think we have attended last 1 month, we have more than 20 meetings. Tomorrow also Pawan is going. Everything, whatever we talk, is completely talk for the complete value chain, right? From hatchery, feed, everything. So whatever we ask, we say like whatever you give for everyone. That's how you see whatever is happening today because of continuous follow-up at the forend from the exporters. We don't have that crisis. For example, like we are in the textiles, are there in the ministry. So they're saying there's none of the POs are revised. So we don't have that crisis issue as such. So I think moreover regarding markets, we have better markets. FTAs are going on. Companies are trying already. You're talking about selling to new countries, but people should understand most of the companies are more than 15, 20 years in the business. We all started with UK, Europe, Japan, other countries. US came mostly from last 10 years, 12 years, right? So we have our customer base in each country. So reviving business to that country is not a big task for most of the companies. Only thing is because of the cost per unit price revenues are much lesser compared to US is only 100. And today you see most of them already are trying to sell to US, I mean UK, other countries. So getting into new markets is not a big time issue, but if you lose the customer in US, we have built this industry in the last 25 years, building the customer base. So just losing a customer, we cannot go back. For example, tomorrow, next month, it comes back to 25%. So if you stop doing the business, right, we cannot get the customer. So you're balancing out, trying to balance US customer, trying to do the new market. So it's happening. It's not that nothing is happening, but it's happening. It takes time. And if you think about the price per revenue, people are talking about declaring an exports. People should understand already the invoices today are 150%, 56% increased. We reduced 30% volume also. Still, we are doing 20% growth in top line. So people should understand banks or anyone, our credit risks are given as per working capital requirement of business. So our business is already, for example, my business reduced by 30%, right? For example, our tariffs increased by how much? Around nearly 50%. So still my top revenue is still 20% more. I'm going to cover that cost, right? So revenue side, we are not worrying much, but we are worrying more about the customer base. And I think we are very closely working with, yesterday we had a meeting with RBI yesterday with Mumbai. So we are explaining about this removal of removal of post-shipment limits. Today, the need of the hour is post-shipment limits for business because invoice value, which instead of 100 rupees, is 160 rupees today. So today, what we require for exporters is post-shipment banking limits. So yesterday we had a meeting, and I think these things all will come out in next 2 to 3 weeks. I think we are not much panicked as of now, and things are okay as of now.
Okay.
Yeah.
Okay. I think we had that question on what kind of a support expectation of the government. I think you've already answered that.
Yes.
And, yeah, given I think we are already running out of time. So I will also take some questions from some of the questions have actually come from the audiences.
Yes.
We will, if you allow me, I'll take some of these questions, sir, to you.
Yes.
I think there's a couple of questions on the feed actually. So do you think the prices of feed must come down in order to be competitive? It's from one Mr. Sriram. And there's another question which is similarly coming, could you please walk us through the price trend of the fish meal in the last 15 months and if,
We may not actually because we are not in feed business, but I think one point regarding feed price, right? Everyone in the value chain has a margin to observe. For example, tomorrow this 50% continues, right?
Yeah.
Everywhere it has to observe that, and maybe feed mill is one thing, but we don't know. Sometimes fish mill increases, and I think each business is different. So we cannot say that the feed has to be sold at this price because we don't know their economics. So as far as exports, all same thing. That's why we are asking tariff component from buyer. So we cannot adjust any of the margins for tariffs. That is what I understand. Raw material price we are able to adjust because we are paying very high than the Ecuador. So that's why we're able to adjust the 10% on the 30 count, 40 or 50 counts. But feed mill, I think that is up to the feed mills companies to decide what to come on the price and all, right? But eventually, state government Andhra Pradesh is working very hard to get this power subsidy for farmers. So the power subsidy comes from 3.5 rupee to 1.5 rupee. They will save around 20 rupees per kilo at farming side. So that is a big thing. I think they are working very closely with state government, and it may come out soon from Andhra Pradesh. So that is one cost we can reduce at the farmer side. And when we are at the meeting with the Commerce Ministry and Finance Ministry, so the question they are asking is, we give incentive to exporter. How does it go to the farmer and next level of the value chain? So we suggested them actually as a committee, we have decided, and from the national committee, we suggested every industry like hatchery, feed mills, or farmers, they need power power is main for the farming or any of the early chain. So we said, whatever you want to do, at least, okay, other than the exporters incentives, power cost is one cost which you can give through the state governments. So they're, very proactive. They're also not understanding. Because they're not able to decide, right, what incentive to be given to exporter, what to be given to farmer and all, how much moratorium to be given. So they need numbers to decide as a government. So we give this suggestion so that they'll get incentivized at every level, so that the cost tomorrow, if something happens on 50%, right, we still have that cushion at different levels to observe. So we are working towards that actually.
Okay. Mr. Thomas, I think Penver is into feed trading and all that, but would you like to answer that part of it? How competitive are we in terms of feed costs vis-a-vis?
I think our feed cost compared to Ecuador is high. Basically, as you know, this is controlled by private companies. I cannot demand or I cannot tell the feed price has to come down or anything like that. But in the long run, when there is more companies getting into that, so if you would look at the feed manufacturing, look at 7 years before, there was a couple of companies into feed manufacturing. Look at what is happening right now. So when the demand comes down, or the availability goes up, definitely it will affect the pricing and it has to come down, definitely, for India to be competitive.
Okay. The other question is on, okay, I think partially which is answered actually. While we have a good presence in process peel segment, do you see an opportunity to convert more of this processed into value-added segment? I think that was, part of the discussion we had something. And one of the other question is on the key market in US. What is in US? What is our end user segment? Is it directly consumed by the retail end user segment through retail outlets, or is it more like a Horeca-led customer base, like hotels and restaurants? This one.
See, our major this thing is into retail. Our food service, if you compare our food service with the retail, our volume is into retail. Of course, food service also plays a major, sector. So this thing is more into retail.
Retail, okay. But how does it, would companies feeding the hotel segment be able to pass on the inflation vis-a-vis someone catering to, like you catering to the retail segment, because they are already burdened with.
So it's not easy. You can imagine if the tariff doesn't come down, it is not easy for anybody to pass on. We can temporarily say, yeah, we will not have a problem, but in the long run, it is going to affect the consumption. So it's not easy. So our government will definitely work to make sure that the tariff comes down. The consumption is not going to remain at the same pace. So we as exporters needs to look at promoting shrimp exports, like what happened as far as avocado is concerned, as far as US is concerned. If you look at the consumption, it is very comparatively very very less. So we as exporters has to put in more money. We as exporters with the importers has to put in more money to promote shrimp, to say that it is a safe product and other things, and which we have to promote the consumption. That is the only way at this particular point of time. Otherwise, if the prices gets passed on to the end consumer, definitely the consumption will come down, which we will definitely are talking about it with the importers. We have an association. We're discussing all those. We are going to promote this thing, but yeah, there is a threat as if the price goes up. But definitely it will come. If it's only the 25%, let me tell you, it is not going to have a major impact. For example, this 25%, there is a high. Everybody will be. It is not going to be the 25% that goes on to the end customer. Basically, there will be this thing which it has to come down as far as the raw material price is concerned. The middle level, the importer level, the margins has to go down. There's a higher margins that's been taken by the retailers and the distributor that has to go down. Of course, a certain percentage will be passed on to the end consumer. So promotions is another way forward, which we need to get more people to eat shrimp. That is the way forward for us to grow.
I'll add one more point regarding this end consumer
Mr.
price.
Ganga, we can also add to what is the domestic opportunities.
One more point I would
question
add to Mr. Thomas, what he said regarding the end consumer price in USA, right? So last week we had one presentation of the US presentation going on. Not only here, NFI is there, Restaurant Association of US is there, which are working and lobbying very closely with the US government to see that this is not affected much on the food products. They're trying to get this exempted. So that is one part. And regarding information, what we have from the importing countries, when US, there is a recent presentation we saw. Tilapia product, whatever the tariff increase is completely passed to consumer. And for example, shrimp is there, right? They're able to pass only 8 to 10%, although there's a 25% hike, for example, on the base tariff, right? They passed only 10% hike to the end consumer. So 10% didn't matter much. So, but as time goes on, at Mr. Phillips told, right? If there is still it goes on, right? Because they're having their own stocks there, they did not pass much. But eventually, the middle retailers and are trying to take that, absorb some cushion. So end consumers are not completely affected like other products, like other egg or bananas and all, right? It's 100% transferred to the consumer, but it's not transferred in shrimp. So there is a recent presentation we saw in US. And regarding the domestic, this is a big topic happening, and not whatever meeting we go, right? Finance Ministry, Fisheries Ministry, anywhere, commerce ministry, everyone talking about domestic. See, one thing you have to understand, sir, domestic, yes, for sure, there's a huge demand. But today, the logistic, there are two things which is hindering exporters to go big way in domestic. One is the logistics, big thing, because India is too huge. Cold chain logistics are limited. And the second very important thing, because we are in domestic from last 15 years, we have our own brand called Aquadate. But the main challenge what we are facing is receivable risk. So yesterday we had a meeting with RBI, we informed them, you need to give some type of receivable risk insurance cover, like for export, we have an Export Credit Guarantee Corporation, right? I said, you need to allot some funds for domestic insurance for receivables also. Then only this business can flourish in India. Otherwise, it's no way people can try to do any risk, because we have lost, people have done a lot of spending on domestic marketing. Some people have spent more than 5 to 10 crores also. So it's not just like we didn't try. We tried out, but the main thing is the receivable risk here. And we asked yesterday RBI to, but demand side, you believe there is a lot of demand for sure. There is no access for good quality shrimp in India, and everyone at least want to have it. So we don't have that. We see this Blinkit, Zepto and all, right? We should be in such a way where we can deliver within 5 minutes to any customer. So I don't think that type of logistics and receivables are there. And any of the online markets, right, they're asking a markup of 20%, 30%. So how can we, product is already 800 rupees, 1,000 rupees, right? How can we give markup to these guys in between, like Zepto, Blinkit, or Zomato? We cannot give so much of cost to them, but I think these things get corrected, right? You can go big way in India too. There's no doubt, but this is the hindrance we have to develop on. Receivable risk is the only main hindrance we have.
Got it, sir.
Yeah.
Okay. I think we are already 15 minutes past 1 hour. I think more questions are there, but I think we will try to conclude this session now. The way I think the things are emerging is, for this sector, which derives nearly half of revenue from the US, while this 50% incremental tariff is a distinct disadvantage, I think the exporters see this as an opportunity to reduce the over dependence on US. And we have bigger markets, European Union, Japan, and others. And not to leave our own domestic market, there is still, these are opportunities for us. And again, we will, while these markets presents different challenges and opportunities, we need to balance our export strategy to maximize the returns. And equally, if this tariff sustains at this rate, and we are talking about a potential economic fallout on the entire value chain, we are also hoping that these tariffs will fall back to a more reasonable level. And further, the key nations, competing nations, face certain limitations in terms of inadequate processing infrastructure or the limited export formats, unlike India's diverse grades and value-added products. And in some cases, we talked about high labor costs, which we believe will also prevent them from becoming a viable substitute for India in the US market. Having said that, I think an urgent intervention by the government to navigate the situation is the prime ask from our exporters. I think with this, we conclude our webinar. Thank you. Thank you so much, sirs. Over to you, Mamta.
Thank you, Karthik, for moderating the session. Once again, we thank all our guest speakers for their insightful views. It was a privilege to host you. And lastly, thank you to all the participants for taking the time out and being a part of this CareEdge webinar. For any further queries, feedback, or suggestions, please write to us at the feedback mail. Goodbye for now. Requesting the tech team to kindly log off.
Thank you.
Yes.
Thank you, everyone. Thanks.